What would change in your life if you had predictable income that you didn't have to show up for? Welcome. My name is Rebecca Taylor. I'm one of the founders of Mach Speed Lending, and we are so excited that you're here today for our investor alignment webinar. I have one of my colleagues, Matt Weens, another co-founder here with us. He'll say hello.
Hi, everyone. Excited to have you guys here today to learn a little bit more about Mach Speed Lending. Let me throw up the slides and we'll get kicked off.
So let's start off with a statement. Financial freedom is not a wealth problem. It's a cash flow problem. Financial freedom is not a wealth problem. It's a cash flow problem. Think back. Where does your money come from? And where does it go? Many people we talk to all day long have high incomes, but few people are financially free. What does that mean? What does financial freedom mean? It means that they can choose what they want to do with their time and when they want to do it. They can choose how they spend it. They have income coming in from somewhere else, so they don't have to clock in every day to a 9 to 5. What it boils down to is, do you have assets that are paying you? And if not, you're not free. You're just well employed. So before we go any further, we have to share these disclaimers. I'm not going to read through all of this today. Take a screenshot, but it'll give you just an overview of the risk involved and the fact that we are making no financial promises. We are not CPAs. We're not attorneys. Please consult your own. This is truly for educational purposes only. So 3 things that you're going to understand by the end of this presentation today. Number 1, is a debt fund right for you? It's not for everyone, but we want you to take an honest assessment of where it is you're sitting today. It may be uncomfortable, but we want you to sit in that and think about what you're feeling, what you're experiencing. And as you look at private lending, to truly be able to assess whether or not it makes sense for you. Number 2, we're going to talk about how we protect and grow capital. You've worked really hard for your money, and we want you to know that we're going to protect it. And so we'll talk about our philosophy, our decision framework, real deals. We'll show you some real deals that we're doing and how we're mitigating risk. It is so important at the end of the day that we're protecting your capital. We're protecting our own capital. Our capital was the first into the fund. And so we'll also talk about how we grow it and the opportunity there. Last but not least, we will talk about our team and our background, our experience, our track record, and what partnership looks like. Does this sound like you? I'm still trading time for money. Every day, you have to clock in for a job. If you're not there, you're not going to get paid. I have one income stream, and it's my job. If I lost it tomorrow, my family would be in trouble. Quitting my job is not an option, not even one that I can consider. I would love to, but I can't. My 401k is my only retirement plan. There's nothing else working on your behalf and helping you prepare for retirement. These are not hypotheticals. These are real conversations with real people that we have every day, and we've been there too. What would change in my life if I had predictable income I didn't have to show up for? What would it look like on a Tuesday 5 years from now? You're not on vacation. It's just a Tuesday, and you get to decide how you use your day, how you use your time. So take just a minute, 30 seconds to think about this.
Thanks, Rebecca. That's such a good frame. What would happen for you on a Tuesday in 5 years if you had things that were paying you, whether you showed up or not? That's an exciting place to be at. And I think the reason we asked that question ultimately is we were where you are if you resonated with those questions, or excuse me, those statements that Rebecca had just mentioned. My parents came from modest means. Their path up was the one that we've all heard. Work hard, get an education, and land a good job. It's the baby boomer roadmap. And that's what they handed down to me. So I followed it. And I got my mechanical engineering degree. And in 2014, I joined ConocoPhillips as a drilling engineer. The picture that is seen here is me 1 week into the job. Year after year, project after project, I climbed the ladder until 2021, where I was leading the team that would drill the longest well in North America. It was the Everest of our industry. On paper, I had made it. But finishing that project, I didn't feel what I thought I would. Instead of fulfillment, there was a creeping emptiness, a realization that the higher I climbed, the more I was going to have to give up at home. And the more I started to wonder, is this really what I wanted life to look like? In January of 2024, through a stroke of fate, to this day, I still don't know why I picked it on the beach. I read Rich Dad, Poor Dad, sitting in the chair with my feet in the sand, listening to Robert Kiyosaki's words. Suddenly, it all clicked. This was not just a career problem. This was a life problem. I realized that I needed to start building streams of income that gave me flexibility, freedom, and choice, not just another job title. When I got home, I started to make changes. I joined a real estate group, I invested in assisted living, and I found private lending. But not everybody understood. At the end of 2025, mom was visiting. My son had just broken his leg in a freak accident at the trampoline park. So emotions were already pretty high. I tried to explain my new direction, how I was investing, chasing something different. She just looked at me, eyebrows raised, and said, okay. Conversation ended there. It was awkward and it was heavy. I could feel her confusion and maybe even her disappointment hanging in the air. That night, laying in bed, I was wrestling with whether I'd let everybody down. My mom clearly didn't get it. The timing couldn't have been harder. My wife just started nurse practitioner school. It was her first real chance to trace one of her own dreams after a decade of supporting mine. I told her I'd be there. Now here I was, running her home with this new idea, new direction in real estate. In the middle of all that doubt, she reached over and she took my hand and said, I don't have to understand your dream to support it. I believe in you. That moment, her belief, especially when she could have doubted, it's what gives me the courage to continue building something that is truly ours. It's the moment that I look back on the hard days that helps me push through. Here's what I realized. Having one income stream depending solely on your employer, it puts your future in someone else's hands. If it's the life that you really want, you don't have to depend on somebody else. You can build flexibility, options, and resilience. You can live life on your own terms, even if the people who love you most don't always understand the vision at first. So what if it could be different? What if you could have predictable quarterly income? And that's without managing the tenants, the toilets, the deals, anything like a business. What about if you had a list of assets that was paying you whether you were working or not? What if your future shifts from employee dependent to investment driven? What if you have real optionality that's built on real cash flow? You have 6, 7, 8 things that are coming to your bank account every month. That's not your job and it's paying you. That's what building income producing assets looks like. So, are you still with us? Did you resonate with some of those statements that Rebecca talked about? You're trading time for money. Did you resonate anything with the story? Working your W-2 job. You make a lot of money, but you're not financially free. What if it interests you to learn more about what that future could look like with predictable income that you don't have to show up for? If so, let's continue on. We're excited to talk a little bit about what Mach Speed is. So if your capital could work something like this, private lending is super simple. A really key takeaway is private lending is like being the bank. On the left side, we have our investors. In the middle, we have the fund, or basically a bank. On the right, we have a fleet of loans. It flows just like this. Investors' capital comes into our fund, just like a depositor comes into a bank with their money. The bank or our fund deploys that money into a fleet of loans in all different properties for us. So all that capital is backed by real assets that I can go touch. Those loans, the interest gets repaid back to the fund. And then we pay our return to our investors and we keep a spread. JP Morgan Chase, Wells Fargo, Citigroup, any bank in the world works exactly like this. And that's exactly how the Mach Speed Debt Fund works. Why is that? Why do people set it up like this? Because they're not betting on the projects. You're baking it. You have a first position lien behind an actual tangible piece of real estate. So, key takeaway, Mach Speed operates just like a bank, and you, the investor, are just like a depositor into a bank. Where do you sit? We have about 4 questions to ask, and they're on sliding scales, the answers. And I think we want to see, where do you resonate with this investment? With what I described, how Mach Speed Lending operates as a bank, is this the right investment for part of your portfolio? So the first one is risk versus structure. On one side, you're chasing the highest yield possible, high risk investments. And then on the other side, you have consistent asset-backed returns. I like to describe it to people as, on one side, you're a venture capital firm, you're investing in hundreds of companies, and you're looking for that next Uber. You're looking for the next ChatGPT or Claude to get invested in. Or on the other side, you have US Treasuries, consistent, backed by the US government, and you have a low yield, but you know it's there and you know your money is safe. Mach Speed is right next to the US Treasuries. You pay 2 to 3 times higher yield than the US Treasury, but we're backed by physical real estate. Control. How active do you want to be when you're creating predictable income? Are you wanting to manage every single day-to-day decision? Or you want capital to go work when you're not there? Do you want to go chase other projects, work on other things, serve different people? Where are you on this scale? Mach Speed Lending, once you're invested into the fund, we do the work. Every quarter, you get paid back your dividend and get an investor statement and communications from us every month. Liquidity. How much access do you need to this capital? Are you willing to tie this up 5, 7, 10 years into a project? Or do you need daily access? Do you need to be able to get it within minutes online? Mach Speed, we have a 1-year term. After 12 months, you can keep your money in the fund. You can take that money back out. Whatever is up to you after 12 months. And your return profile. Really, do you have a long horizon and a high risk tolerance? Or are you looking for something predictable, contractual, something that pays you every quarter, that helps you essentially pay the bills or replace that active W-2 income? That's what we are at Mach Speed. We're predictable, we're contractual returns that pay you every quarter. So if you found yourself on the right side, Mach Speed might make sense for you. It might be aligned with you. So let's jump into the kind of nuts and bolts of how we think about private lending and how we execute our business. What's our philosophy? The first one and the fundamental one is, why would people use private lending? We hear that a lot. Your interest rate is higher, your the cost of capital is higher. Why would someone use you? Really, we're filling the gap that the bank won't. Banks want the cookie cutter street from the 1950s movie that basically they can package up all those mortgages on that street and they can go have $1 billion worth of mortgages, make a 2% yield, and be really happy. Where we fill the gap is for those properties that aren't as straightforward, that might need a lot of work to get back up, that might need a major rehab, that people need access to capital to move it from one state to a state that's ready to sell, or refinance. That's where private lending fills the gap. The banks don't want to touch assets that aren't in their very tight box. We finance the assets, not the application. The number one thing we look at is what is that property worth versus what we are lending on it. That is the number one thing that we look at. Not how fancy the application is, not how great the pictures look at. Really, what is the fundamental value of that property? We focus on short term versus long term. Our typical loan is about 6 months. We aren't a 30-year mortgage. Like I said, we're helping investors transition a property from one state to a new state. They want to capture that value as they increase its value through the 6-month loan. And then they want to either refinance it into a long-term rental or they want to sell that property. So where do we lend? We like to describe that as we are deal focused and we're market agnostic. That goes back to if the asset is good versus the amount we have to loan on it, we will do that deal. We will do all the due diligence on the area. We'll make sure that we have some boots on the ground, but really we're focused on what the deal is, not necessarily what the market is. We say no more than we say yes. Right now, for every 3 applications that come in, we're saying no to 2 of them. It's a really powerful position to be in, to make sure that you're always putting your money in the thing that is the best deal for our investors and being a good steward of capital. And again, collateral first, borrower experience second. Collateral is the number one thing. It's what the deed of trust, it's what the fallback is in a bad day scenario. But the borrower's experience is extremely important as well. We require 3 like-kind projects before we would actually lend to someone. Funny story, we're actually going through that this week. A borrower is going to have to partner with a more experienced person on a few projects, and currently on one project that we're going to lend on because he doesn't have the experience. He has all the other things, but he doesn't have the experience. So he brought in someone who does have that experience so they can execute the project and he can build his resume. All right. How do we think about capital at Mach Speed Lending? What does the process actually look like as we go forward? So this is a very high level of our process. The first thing we do is we screen it. We have basic questions like, is the property in the US? Does the borrower have liquidity? Do they have an actual purchase and sale agreement with all the right entity and names and addresses on it? Those are some of the basic questions. Once we are thinking, oh, this looks like a good deal, we'll send out a term sheet, it gets signed, and we move that deal to underwriting. Underwriting, we have a detailed SOP that we follow as a full document checklist. What are all the things we're looking for on each document specifically? We give title instructions out to the title company, and we get the process working there to make sure that the loan we're about to do is of high quality. During that process, we stress test it. We say, what happens if it's 2008? In 2008, the market dropped by 25% average across the United States. It's really where that 75% ARV happens. That's how we think about it. If another 2008 happened, how would this property execute? How would the borrower be able to, what are his options to offload the property into either a different loan? And what happens ultimately if we have to take this property over? What would that look like? Are we able to get the property sold? Are we able to execute the business plan? What does that look like? Once we get comfortable with that, we move on to drafting up the legal documents. This includes a deed of trust, which basically secures the property, personal guarantee, which is the borrower saying that they are personally guaranteed an amount of money that we are lending them, then a promissory note, which lays out all those things, the payment plan of the loan. In the last step, all three of us have a veto vote. We all look at the loan analysis that was done during underwriting. And if one of us doesn't like it, we can veto that loan and not do it. And really the last question that we ask is, if we have to own this property, are we going to be excited? And that's a great filter to really understand, do you want to lend on a property? Once we say yes to that, we fund the project. Most of our opportunities are dying on the left side of the screen before they get to the right side. And that's really important, is that quick screen really helps us out on that front. So some of the metrics, I mentioned that underwriting checklist, 32 points on documents, things that we look at, insurance, the expiration date, is the address right, all those different things in the checklist. Right now, our portfolio is about 60% of that after repair value. Our target is 75% or less. We're well below that threshold. And then transparency, we are an open book. We're happy to talk about any of our loans. On our investor statements, you'll see every address that we're loaning on and what its current position is, and is it up to date. We're always here. We think transparency and integrity are super important, and we're always here to have that conversation with our investors. What does bad look like? What do we walk away from? The borrower doesn't really have skin in the game. If they were able to walk away from the property on a bad day scenario, that doesn't mean that the lender and the borrower are aligned. So with loan documents, with equity up front, all different types of mechanisms we use to ensure the borrower feels like they have skin in the game. That margin's too tight, 75%. Maybe it's over that. Maybe it's right on that. We just don't feel like it's close enough. We don't feel like it's a good deal. We'll walk away from those. The borrower doesn't have experience. I mentioned this. 3 like-kind projects is what we require from borrowers, especially new ones. But if they don't have this experience, we'll ask them to partner with someone who does, or we won't lend to them. Borrowers that don't pass the background check, this is a simple step, but our moral values as a company, we're not going to lend people that don't pass a background check. And ultimately, that question we ask, would we own that property ourselves if things all go sideways?
So we're going to walk you through a few examples of projects that we've funded. We do a mix of fix and flips, rehab projects, new construction, and transactional loans like gap funding. And so this is one of the projects we've done in Madison Heights, Virginia. It was actually a pretty light rehab for the borrower. They are very experienced and found the property off market. It didn't need huge renovations. They were able to go in and paint the whole house, rehab the floors, refinish the floors, put in new light fixtures, put in some new kitchen countertops and cabinets, and just minimal things, make the basement, cleaned up the basement and just made it look nice. And you can see where they sold this at, $275,100. They made an incredible profit on this, over 100,000. And on our end, we made over 9,000 on the interest piece. They did this in 152 days, which is below the 6-month window that we typically do. And one thing I want to point out is that loan to value at 55%. We are very conservative in the loans that we do, as Matt alluded to already. We want to mitigate risk. And so you can see that loan to value is pretty low. And we err again on being conservative. And so this is one example. We were so excited for the borrower to make an amazing return, and we're excited to continue to support him on future projects. The next one is a new construction property. This is with one of our largest borrowers. He has been building for 25 years. He does a lot of new construction, and he found this lot off market. He was able to get it at a great price, and he built this house in 155 days. He held the loan, and you can see he also made a fantastic return on his money. This one he actually refinanced. He's holding as a rental, and a lot of our borrowers will do that. They don't always sell them. They'll hold on to them and build their portfolio. And we just love being able to partner with them and help them grow their investments as well and be a partner in that. So you can see the interest that we earned. And again, back to that LTV, it is very conservative. We're at 57%, well below that 75% mark that we are willing to go up to. But I would say for the most part, we stay far below that. We want to be conservative and protect your capital, make sure that we have plenty of equity in the deal if a borrower ever decides to hit the road and we have to do something else with the property. In that scenario, again, we might sell it, we might rehab it ourselves and turn it around. So being conservative is of utmost importance to our company.
So what are those questions that you should be asking? Rebecca just took us through some of those example properties we've had, but how does that relate to you as an investor and your position in the fund? What if the real estate market crashes? I mentioned 2008 already. The average home price dropped by 25%. And those two case studies are perfect examples of high quality loans. If 2008 happened in the middle of those, we might have to take over one of those properties, but such a good position in it, holding it as a rental or being able to kind of fire sale it at a pretty good deal for people, we would still get back our capital back from our investors. And that's the ultimate goal. It's nice to get the interest and the fees back. We might have to get those on the backside with the personal guarantee, but at least get that investor capital, make sure that it's protected. What if the borrower takes the money and runs? We use construction draws. What does that mean? If we're going to loan $200,000 on a property and 100 is for purchase and 100 is for rehab, we will show up to the closing table with the agreed amount for the borrower with the $100,000 down, but we don't show up with the 200,000. We hold those back in construction draws. If a borrower, once they have completed the work, we will then fund a draw as we go. That includes usually a site visit or a walkthrough with a video. We don't give out the 200,000 right up front where they could just take the money and run away. That's why we like to lend on the property. And then we have our deed of trust. And then as they improve the value of that project, we then distribute out those funds. Another way that we have borrowers' skin in the game. So what if a borrower doesn't pay? This is where legal documents come up, right? Legal documents are for when things are not going well, right? We have our deed of trust, where we can take and access the property if we need to. We have a personal guarantee, where we can access some of those assets that we vetted in the underwriting part of the process. And we have the promissory note, which outlines the return of the loan for us and what they're obligated to pay us.
So how did we get here? First and foremost, we've all been operators. We actually met in the assisted living space. We've all invested in assisted living. We still invest in assisted living. We've also been a part of multifamily transactions. All three of us have short-term rental properties. We also have small residential properties. We've been private lending for years. We've done it all. We've sat in the buyer seat, the seller seat, the lender seat. We've got decades of experience transacting real estate loans. One thing we realized is a pattern. The lender has the leverage because he who holds the cash holds the power. Truly, you see that across the world with banks. They've got the cash and they decide how they use it. And the insight is that you're banking on the project. you're not the one doing the project. And I think so often with real estate investing, people automatically think you've got to deal with toilets or tenants or trash, or you have to be the one flipping the house. But you don't have to do any of those. You can still get cash flow without doing that work. You can leverage your real estate experience. You can leverage our real estate experience and lend money for other people's projects, for them to do the projects. And so we've seen the demand. It's huge and it's continued to grow. And that's why we're so excited about what we're building here and inviting you to help us build. Lastly, the shift. We started lending. Same asset classes, but we were in a completely different seat at the table. We were sitting in that lender's seat. We became the bank, and you can do that as well. So our collective experience, we've transacted over 100 loans, again, in different seats, whether it be the buyer, the seller, the lender. Together, collectively, we have over 28 years of real estate experience and done well over $76 million in loans transacted. So credibility, you can see it's earned through reps, not claims. We're not claiming anything. We truly have been in this space for a long time. And it does represent underwriting decisions, market cycles navigated, and capital deployed across both sides of the stack. So who are we? We've been talking a lot, but a little bit of background on ourselves. Again, I'm Rebecca. I've been investing in real estate with my husband since 2012. We started out with small properties and have grown over time and acquired more assets. I spent 10 years in the tech world doing sales and marketing while investing in real estate on the side, but I always have loved it. It's in my veins. I'm a fourth generation real estate professional. And so I saw, just as time evolved in my time with little ones at home, it was harder to be present for them doing some of the transactions that I was doing as a realtor or even as a property manager. And so I realized lending was a really great space to put my capital to work short term, but still make a really solid return. So I've been lending since 2023, and it's just been an incredible opportunity, again, helping investors put their capital to work too. Lauren Jacobs, who's not here with us today, but he is an awesome partner in our team. He's been also investing in real estate for a long time. He's a fifth generation real estate professional. He's been deal structuring, underwriting, and operations for over 10 years now. He really helps with our strategy, with our vision, with our loan operations, and he's helping get us to the next level as a company. He's bought and sold over 900 real estate units, and he does have a lot of hands-on experience and an approach. And I'll let Matt talk about himself.
Yeah, thanks, Rebecca. Like I said, a little bit in my story is my background is engineering, and really my background is really around risk mitigation is what it ultimately comes down to. So it's really my focus part for the fund is helping ensure the underwriting process is solid, doing the underwriting on the loans, and then also really building the systems for our company as we continue to scale on all those fronts.
So how we partner with investors. Alignment precedes access. We are not the right fit for everyone, and that's okay. We may not be the right fit for you, but you're still here, you're listening today, and we hope that you'll consider partnering with us. We want to make sure, though, that you're aligned with us, but also that we're aligned with you. And so we've probably already connected, had a discovery call, but we want to have a follow-up call to talk more about any questions you might have to make sure that we're completely aligned and talk about next steps. Transparency is non-negotiable. Matt alluded to this already, but we are an open book and we want you to feel totally comfortable coming to us and asking questions. We share monthly updates. Our communication is very proactive. We have monthly updates that we share with our investors, quarterly distributions. We send out annual K1s. You will have an idea of what's going on, and we want that communication to be ongoing. So please reach out, feel free. And lastly, not everyone is invited. This is a 506c fund, which means that you do have to be accredited to invest with us. Being accredited means that you're earning over $200,000 per year as an individual or $300,000 per year as a couple. On the flip side, you also could have a net worth of $1 million. If you don't meet that income requirement, that $1 million net worth cannot include your primary home. So just keep that in mind. Accreditation is required, but we'd love to work with you. And partnering with our investors is what we're after. This is not just a short-term, come and invest and make amazing returns. We want long-term partners that believe in what we're doing. And again, we can help you get to your goals as well. So don't take our word for it. Take a listen to this testimonial from one of our investors.
Hey, my name is Neil, and I work for a Fortune 500 company based in Texas. So I originally started looking into debt funds as a way to diversify away from the stock market into something that paid a steady stream of income at a higher rate than your traditional treasury bond. I eventually found the guys over at Mach Speed Lending, and I really connected with their general model and their way of thinking. The steady and reliable distributions were exactly what I was looking for. But to be honest, the ultimate hook for me was the level of confidence that I have in these guys' understanding of the numbers. They really know how to underwrite real estate deals. You'll find there's a lot of debt funds out there, but in my opinion, there's only a small percentage of them that actually underwrite conservatively. One of the other interesting things that jumped out to me during initial discussions with the team was the depth of knowledge that they have in the self-directed IRA space, which is the path that I ultimately chose. They were able to break it down in a way that was really easy to understand. And they're willing to get into the weeds with you and try to understand your individual situation. And then they can tailor a solution that works best for you. I really appreciated the time they took to go through that with me. Honestly, in general, these guys are really solid, down-to-earth people. They do what they say they're going to do, and I can't recommend them strongly enough.
Thank you so much, Neil, for that testimonial. We appreciate it, and it's been such a pleasure working with him. So these are some of the questions we get quite often. What is the return? You might be listening to this and thinking, this sounds pretty good, but what are you actually going to pay me for my investment? So we have ranges between 10 and 11%, depending on how much you invest in the fund. Between 100,000 and 500,000 is a 10% annualized return. If you're investing over 500,000, it is 11%. We do pay quarterly distributions, and you have the option of reinvesting those distributions, and they compound. The distributions compounds, it grows just a little bit faster. This is a really great option for retirement funds if you're looking to diversify outside of the stock market and self-direct those funds into this option. It will grow a little bit faster, and you don't have to keep worrying about where am I going to distribute or where am I going to place that capital when those distributions hit my account every quarter. The minimum investment is 100,000. And how is my investment protected? We already hit on this. Matt talked a lot about this. We're big on risk mitigation. We're very conservative in our underwriting, but we typically do not lend over 75% of the after repair value. We actually stay often below 70% on that. So we are very cautious. We have a number of legal documents in place that also protect us, protect our investors, including the deed of trust, the personal guarantee, the promissory note, and there's a whole lot of other things that we do to ensure that the investment is protected. The minimum commitment is 12 months. There's a lockup of 1 year, and we do ask for a 90-day redemption window. So if you plan to pull your capital out, just give us a 90-day notice so that we can make sure it's not tied up into a loan. And again, you have the option of reinvesting those proceeds or taking quarterly distributions. So what are the next steps? We'd love for you to book an alignment call with us. You're going to get an email after this with a link that you can click on to schedule some time for just a quick call. We'll answer any open questions you might have and make sure that we're all aligned and on the same page. At Mach Speed Lending, we're getting ready to open up a $1 million capital tranche. We don't do this every day. We have a lot of other investors that are interested in moving forward. And so this is a great opportunity for you if you are interested to move forward. This is really based on loan opportunities in our pipeline that we're looking to fund. So thank you so much for being here today. We appreciate your time on behalf of Matt and I. We're excited about the opportunity to potentially partner together, transform homes and communities while also bringing a consistent, steady return to you. So thank you again. We look forward to connecting.